Well, after spending the morning in the red, the JSE picked up an afternoon trade helped by better than expected retail sales and producer inflation data out of the US, which pushed that market firmer. Joining me now is Nick Kunze, derivatives broker at BJM Private Client Services. He's today's markets watcher. Nick, of course, today we have the anniversary of the Lehman collapse. Do you think that's created some more jitters perhaps in the markets at the moment?
Stephen, I don't know if it's created more jitters, but it's certainly created more awareness that we're not out of the woods just yet. We're heading into what is often called a next couple of weeks where the equity market certainly won't be going anywhere in a hurry. If anything, there's a bit of consolidation. So there was a bit of nervous trade. We followed Asian markets a little bit weaker this morning. But as you pointed out, we've got a bit of a pickup with the US data. But when I left the office, I saw the Dow was actually in negative territory. So very cautious approach, I think, happening in the equity markets right now.
And of course, we know the Dow did open slightly weaker, then picked up on that retail data and also producer inflation figures, so down again at the time. And of course, we have futures close out here in South Africa this week. We also have the quadruple witching in the United States. Will that perhaps pick up volumes at least as the week progresses?
Definitely pick up volumes and probably pick up volatility. I mean, implied volatility onshore and certainly in the States is fairly low. I think the VIX is about 27, 28%, and our local version of the volatility index about 25%. So the implied vol is cheap. You should see that picking up going into closeout, and certainly as traders unwind positions. It should create a little bit of fun and games going into Friday.
As I said, we're having problems with our market data today. Though it looks like the all shares closed about 1/5% stronger. Gold mining index, though, down by 1/4%. And we have the gold price back above $1,000, but we had that rand at 739. And that strong rand must be playing havoc with our commodities counters, some of our financial counters as well, I should imagine.
I imagine there's some very serious conversations going on in boardrooms around the resources right now. The rand at 739 is really detrimental to the likes of Harmony Gold, which has most of its production onshore. Certainly Sasol, which is as much as an oil play, it's also a rand dollar play too. I imagine more of certainly an impetus to cut rates next Tuesday. Even though Pravin Gordon speaking this morning said he wasn't in favour of intervention anyway, which is a good thing. I imagine the odds are definitely stacking up that they're going to have a rate cut. This rand is I don't believe, being factored into earnings going forward, and it's going to be a very negative effect. So
you think the rate cut might actually come to try and weaken the rand rather than to look at the growth of the inflation picture in the country?
Yeah, you can look at inflation. Yes, the inflation trajectory is pointing downwards going forward, but it's still above that 6% band. The mandate for our central bank is to keep rates, to keep the inflation under control. But it's got to be a consideration. And even after, as your earlier guest pointed out, even after the surprise interest rate cut we had last time, the rand is still busy, well beneath the 750 level against the dollar.
Well, something else that could be adding to the market jitters at the moment is the trade spat that seems to be growing between China and the US at the moment over the import of tires. I mean, do you think this rising protectionism could cripple the global trade recovery at this stage?
No, I don't think it could, but it also certainly highlights, Stephen, exactly how keenly priced and how perfectly priced this market is. Whereas 3-4 months ago, or maybe even only sort of 2-3 months ago, a trade spat between and a little bit of toing and froing between the likes of China and America wouldn't have raised any sort of headline news at all. But after the market having run so far, it certainly shows exactly how nervous traders and investors are. Pretty much the whole downward in the last, certainly on yesterday morning, was on the back of this. So it definitely gets the idea that we need some sort of impetus to drive this market forward, and any negative news is going to be taken exactly like that. Even after those very positive data out this afternoon, the US market failed to get a bid and failed to go significantly higher off the back of it.
Of course, you said the market is perfectly priced at the moment. We've seen the bulk of our companies reporting already, so we know what their earnings look like from the previous year. I mean, do you think we'll have to really wait and see another set of earnings from corporates before we can actually push the market any higher?
I think so. Well, actually, funny enough, speaking about this in the office today, the sort of the watermark has been set, so to speak, and the earnings were completely way past any sort of analyst consensus, far better than expected. The money that's been thrown at the problem certainly seems to have helped. Now you have the problem looking forward to third quarter earnings towards the end of October. Is how much better are these earnings going to be comparative to what we've seen right now? So it certainly is raising the bar, certainly for the next quarter. I think any direction is going to be needed. We're not getting out of economic data. Yes, all the boxes are being ticked. Everything besides unemployment is better, and things are looking good. It looks like the trillions of dollars thrown at the problem helped. But any sort of pushing higher, or any sort of move from the S&Ps or the Dow towards 10,000 or higher, is going to need to come from, I believe, some sort of earnings.
Well, just perhaps as a case in point, we had results out from FirstRand today, a 32% fall in normalised earnings to 7.1 billion. Share price was slightly higher, so obviously all the bad news has already been priced into our banks, and our bank shares have been doing pretty well. So we really need to see that this recovery does come through in their earnings next year, don't we?
Exactly. I think our earnings are in a slightly different space to what's happening offshore. I think South Africa's probably 6 months behind in the cycle, whereas certainly Europe, we've seen the GDP numbers looking better, the American economy is looking better. I think South Africa's about half a year behind that cycle. So we've still got some bad news to filter through. But looking at, for example, those FirstRand, exactly, the share was up slightly, but no sort of significant change. And I think in line with its peers, and probably, again, what we alluded to, it's exactly factored into the price.